Welcome back to the channel. My name is Brad. Today we're going to cover YMAG and YMAX. We're going to do both of them simultaneously and give you my opinion, go over the back testing, and talk about pluses and minuses. And we will also, at the end of the video, talk about going to weekly distributions, give you my opinion, and it's only my opinion, and we'll see how these work. So, first of all, YMAG. YMAG is a fund of funds. It's taking everything that is a long ETF, not the hedge ones, but the long ones, and they're bundling them all into a big pile. Okay, that makes sense. You're getting diversification. But at this time in the market, and I'm going to say, if you have held these funds for a long time, good. If you've been piling back in the distributions, even better. If you've been pulling off all those distributions of 40-some%, you're in trouble. And we'll go over the back testing. Now, let's talk about YMAG. This is the Magnificent Seven. So the Magnificent Seven, what is it? It's 7 stocks: Amazon, Microsoft, Nvidia, Google, Apple, Tesla, Facebook. It's all 7 of them put together. Now, my personal opinion on those 7 stocks. Did you know those 7 stocks are greater than the whole entire economy of a little country called China, twice this economy of Japan, and 4 times the economy of the UK? That's just saying those words makes you have to wonder. That's a lot of concentration in one spot. Could it be good? Could it be bad? Back testing, I'm going to just go ahead and go right into the back testing. I'm not going to go through if they're tax efficient and not tax efficient, because each one's independent. They're about 50-50, so they're not as tax efficient as all the rest of them. That really goes to each individual ETF that they're holding. So you got to be careful, right? And we're going to start with YMAX. So YMAX being made up of all these funds. So YMAX, in the back testing, yes, it gave me my 8%. It really didn't give me the margin of error that I would be looking for in an overall fund. I think it's a little too close to that edge. So I would say hold at best. But on the positive side, it did give me my 8% that I like to drag off the top and still be above my original investment. Going on to YMAG, it did significantly better. It really held up significantly better. Yes, it's been a turbulent time for the Magnificent Seven, but it did a lot better than what I would have expected it to do. And I can still drag off my 8%. Now, here is my personal opinion about these funds. Being that YMAG is got some stocks or ETFs that I personally wouldn't hold, and that's just me. I just wouldn't hold them. The fundamentals of those stocks that they're actually writing on is something that I wouldn't do. You're putting a lot more risk in these stocks. And if you like Exxon, if you like JP Morgan, financials are going to do good coming up in the near future due to the Fed cut. Okay, I get it. Maybe that's something you want to get into because of that. I would tell you, look at each individual stock and maybe hold that particular ETF than putting everything in a one bundle and thinking, oh, I got diversification. Not exactly the best thing to do. Now, I personally, I think everybody knows I got some AMZ here recently, and everybody knows I got some NVIDIA here recently. And I want to kind of share some of the backstory of this right now. Let's go ahead and throw this out just for conversations. So let's talk about the fundamentals of each one of these stocks. Just high level fundamentals, real quick. I run out to Seeking Alpha. They have factor grades. All I gotta do is look at the factor grades. If I see more than one red, might not be a stock or an underlying of the stock or ETF or what they're writing the synthetics on. Amazon, it's got one red. Okay, I can live with that. I like that. One red, that looks pretty good. And it's all about, some of them think it's a little overpriced. And over the next couple of years, their projected PE is going to go downwards and be in line where I think it should be. And hey, life is good. Let's make money in between time. Microsoft, a couple of yellows and a red. I don't know if I would personally right now at the price that it's at actually purchase it. I haven't figured out what purchasing number that I would purchase it at, but I wouldn't buy that one just because of that underlying right now. NVIDIA, right? And these are the underlyings now. So NVIDIA would be NVIDIA. All greens, a lot of A pluses, and all they're saying is, hey, it's kind of overpriced. Also, their quants at Seeking Alpha has it as a hold. Same thing with Amazon. So, okay, I get it. I get where they're going with it, right? Google, red, yellow. No, I'll pass. I mean, that's quick. If you got one red, one yellow, not worth it. Not worth it for me. Right? Apple, two reds. No, I'll pass. Tesla, red, couple yellows, pass. Meta's looking pretty good. I personally won't be buying it, right? But this is something that I would look at and say, can I hold this? And I would say maybe. The answer is maybe, right? I haven't done the testing on it. With 4 out of the 7 stocks, something I wouldn't buy, I can't recommend this either. I would buy the 3 that currently look good. I personally have 2 of them. Right? I personally have 2 of them because I want to track these. I have such a small amount, it doesn't even matter if it goes to 0. But it's the point of I bought them because I looked at the underlyings and said, hey, this still has room to grow. I still believe in that compounding effect. My back testing tells me the compounding effect works. So I hold them. Now, that's the end of that video. I'm going to talk about moving to weeklies, in my personal opinion. And it might not be what everybody wants to hear, but there's some positives and negatives. So when I look at the list, hey, I see it. We're going to be getting staggered distributions out of these companies, which means, like a YMAG is going to have 1 or 2 hit one week, 1 or 2 hit the next week, and so on and so forth, right? There's going to be at least 1 week, if you do the math, that's only going to be 1 ETF that you're going to get the money from, which is okay because now you're going to be able to buy the dips. And when the funds go down, you don't have to wait for a whole month. You can get that money on Friday or whenever they're going to distribute it, and you can reinvest it and get those dips. You don't have to wait forever to get it, so you can possibly buy a little dip and get that, dry powder, somebody puts it. Yeah, I have dry powder sitting aside. I'm actually got a significant little dry powder right now, and I'm looking for my next ETF to put it into, and I'll let you guys know when I come across it. But here's the other side of the story. if you polish a turd, you don't make it into a diamond. Meaning, if the underlying is bad to begin with, going to weeklies is not going to do anything for you. That's just my personal opinion. If the underlying is good, then hey, weeklies make sense. If the underlying is bad, it's still bad. That's my 2 cents. Hopefully it all makes sense. It has a positive. You can buy those dips. You can reinvest. You can reinvest early, even though it doesn't move the bar that far. Unless you're buying the dip, then hey, great. But again, it might average out. I haven't tested it. It's one of those things that I want to do back testing on. But I'm not going to waste any more of your time this evening talking about this. I just think that polishing a turd, you don't get a diamond. Now, if it was a diamond and you're polishing it, good job. Weeklies help. And there's a couple weeklies that we hold right now, or at least I hold right now, that I can't find anything that beats them yet. And trust me, I thought I had two that might beat them, and I didn't. They came up a little bit short. But I'm still looking, and I won't stop looking until the next one comes along. But then I'm going to wait 6 months. I want data. I don't guess. I don't have a feeling. I don't follow. I have data that I'm looking at, sharing with you, not your financial advisor, but I'm sharing with you so you can look at it and say, hey, this data makes sense for me. And I looked at this and I looked at that. Maybe this is the right investment. So please use me in that direction. Just don't ask me, hey, should I buy this or not? Not my forte. I don't want to be that person. I want to be able to give you the data and say this is what it is. Until next time, God bless.